Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good afternoon. Ira Epstein of Linn Associates with your agriculture update, and this is for Thursday, the 13th of December, 2018, and we're at about 2:15 p.m. Central Standard Time. So I want you to see the disgust, I guess is the right word, that the market seems to have for the Chinese purchases of soybeans. And the reason is it's not ongoing purchases, and it's not a super large amount. I've now read reports with what we had written last night. We thought the purchases were in the 30-plus cargo area. In the market only reported 12, and I've been reading that people agree it's in that area. It still didn't hold the market, and the reason is what the Chinese are doing is they're not taking off the tariffs, which means you can only have the state-run grain companies buying, and they say they're not bringing it to the crushers. They're going to use it for storage. So the Chinese did what they said, but it's not far enough. And why would they take off the tariffs until they have a trade deal with the United States? They're living up to what they said. Okay. When we see the corn down a little bit, but it's the wheat that's getting strong around the world. Some concerns that Russia may stop exporting wheat, so you got to be careful there. When we take a look in the weekly area chart of closes, we're getting our first bit of a correction of any real sequence going here, down 9 3/4. When I say sequence, you went up, backed off, up, backed off, up, backing off. That's all I'm saying. It's not a big drop, not through prior week's lows or anything of that nature. We still have an upward biased market. When we take a look at a daily bar chart, you still see that you had that gap. You filled most of it. There might be a quarter cent, I'd have to look, but it's a little bit left there. Generally, the whole thing gets filled. When we look at today's break low, it took out a previous break low, and this is the swing line study. This is the same chart without it, but when you put a swing line on, it gets easy to see as the market making higher highs, higher lows, lower highs, lower lows. You're looking for trends, and no trend means you have a higher high and a lower low, which is exactly what this market did. So when we put moving averages on, the support comes in back, if it wants to go there, to what I call that line in the sand, the 896.5 zone. The Bollinger Bands are what have been stopping the rally from going anywhere. They got rather wide out here. I would not be surprised, and you shouldn't be, to see them start rolling over and narrowing in again. It appears for at least a moment that the Chinese news got discounted, and it's now past history. When we look at momentum in the slow stochastic, today was the day that you had to be up to have the market embed or lock in the bull trend. Didn't happen. The market slipped back with one of the numbers under 80. You're just in an overbought market that now has to figure out what it does to get out of that condition. Often it breaks. In the meal market, you can see how you failed against the upper Bollinger Band yesterday, slid down today, took out a previous low. So again, you have no trend. You have a higher high, lower low that is really caught. If you look at the black Bollinger Band, which is the resistance point, support point, sideways, momentum's down, bias down now, but a market that's really void of a trend. Soybean oil is still in an uptrend. If the red line closes under 80, what would happen then is I would think price and the 18-day average would likely come together, not the 100-day, because in order to get that to happen, the odds are you'd be under the 100-day average, so it would put the closest of then under the market, the 18. You're not there yet. It's still the strongest part of the soy complex. In the corn market, you can see you have the embedded readings. Both numbers over 80 today. Over 80 yesterday, day before, not the day before. So until the red line closes under 80, I say breaks in this market will still find willing buyers. We'll see if I'm right or wrong on that. And in the wheat market, up and over the upper Bollinger Band in an overbought condition, I'd be a bit cautious here. This market has a tendency not to stay above or below those Bollinger Bands, and while it can push them up, it often works its way one day over, the other day under, as it pushes on the band to try to go higher. Next resistance point, 541 3/4, the 100-day average of closes. The sugar market broke down today, and when it got under 1262, it threw in a pattern of lower highs, lower lows, but then it came back and closed over 1270. So it came back just enough to not give a full-fledged sell signal. What do I mean by that? In order to get full-fledged, it has to close under the 18-day average. It didn't do that. In the coffee market, we're having an outside day up. After this big of a break, you can at any point get a hard bounce out of this market, and as such with a key reversal. Why is this a key reversal, not just an outside day? Because of the break low, it's the lowest of the lows. That's all that it is. I will still defer to my slow stochastic. When and if it's lost, I'll look for price in the 18-day average to make a run at each other. Could be tomorrow, day after, I don't know. But until it happens, even with these big reversals, I say that above the market there's willing sellers. In the cocoa market, you can see that yesterday the market created a pattern of higher lows, higher high over the 18-day average. Next resistance would have been the 100-day, and then if you get above that, maybe the upper Bollinger Band. That's what you did today, and you can see the upper Bollinger Band did a good job of holding the market back from it. So we'll see what happens next. In other words, it couldn't accelerate once it got up there. In the cotton market, we're still in a bearish pattern of lower highs, and with today's break low, lower lows now. Will the market close under the 18-day average? Don't know. But if it does, that could send this market into a bearish pattern because momentum is turning down, as you can see. In the cattle market, you keep coming up to these upper Bollinger Bands, backing off, but pushing it out like I'm telling you wheat might do. So that's what you look for. Look at this example when you take a look there. And the market has now got one day, as you can see, both numbers over 80. Yesterday, both over 80. The day before, right on the 80 number. So I'll call that embedded, for lack of a better word. Support all the way back at 121.15. Resistance, the upper Bollinger Band. Feeder cattle, a bottom in place and running to the upside. Once it closed over this number, that the 18-day average with the pattern of higher lows, higher highs, full-fledged buy signal came in. You would be wrong if you got under this one, or at least the trend would be broken if you got under or stopped to the upside if you got under 143.30 on this market. If it can reach up, maybe it gets up to the 100-day average in the upper Bollinger Band. That seems to be what the market's trying to do. And in the hog market, you had a sell signal. Now, as you can see, you've got lower low, lower highs under the 18-day average, momentum down. First objective would be the closest of a key moving average, or the Bollinger Band, the closest of. It's the Bollinger Band. You can see what it did today, and again, it got its support. That's not a sign it's going to turn up. It's still very much in the downtrend. I teach this and a heck of a lot more in great detail in my charting course. And folks, it is not expensive. If you're a trader, it's a couple of ticks in an S&P. The course now is $99.95 right up to Christmas. Then I'm going to kick the price up probably to about $170 or so. So if you'd like to see 6 hours of videos to teach you what to do, learn chart patterns, learn the techniques we have. It also has window envelopes, stochastics, the little ins and outs that I know about the market. I'll keep adding to it, in fact, this year, and the course keeps getting better and better, and that's the whole idea. And by the way, you're looking at, I don't know how many generations of this I've done, but I've been teaching since 80s. So I keep going further, and of course technology makes it easy. But you get all the videos, I teach you how to do the charting, how to set your charts up, what you need, and it's a great gift for somebody. It's a heck of a lot better than a sweater or a pair of socks that's sitting there. How do you get it becomes the question. Well, one of the best things you could do is call the staff. They'll get it all set up for you right away, and away you go. You can buy it on our website at www.iraepstein.com. Go under the word education. It'll have a facts page, FAQ page. It teach you all about what's going on, explain how this works, and you don't need a code. The course is going to be $99.95. It includes the charting software. It's going to have the market research, my daily updates for you, everything that you need to get going. I'm Ira Epstein. You have a good day.